Forget falling mortgage rates for a second. The real inflation time bomb ticking right now isn't in your interest payment, it's in your grocery cart. I'm talking about a subtle, persistent surge that the Fed's 2% target isn't touching, and it's quietly eroding your buying power even as housing markets like Austin and Boise show inventory gains. Look, by early 2025, the U.S. Bureau of Labor Statistics reported overall consumer prices cooling. That sounded great on paper, right? But while the media focused on the headline numbers, something deeper was brewing underneath. And what if I told you the very mechanisms designed to cool one part of the economy are actually accelerating the other, hitting your wallet twice as hard? This isn't about 2008-style housing collapse. It's about a new, more insidious kind of financial squeeze. So, what's really driving up the cost of everyday living in 2026? And how does it tie back to the very real estate market you're watching? You're feeling it, aren't you? That double punch to the wallet every time you hit the grocery store, followed by a quick gut check on your mortgage rate. It's not just a hunch. The data tells a stark story. By early 2025, while the Federal Reserve was patting itself on the back for nudging inflation towards its 2% target, a deeper, more insidious pressure was building beneath the surface. For instance, according to Realtor.com's May 2025 report, housing inventory across the U.S. shot up by a staggering 31.5% year-over-year. That sounds like good news, right? More homes mean more choices, maybe even lower prices. But hold on, because that same report from Realtor.com research data, authored by Jake Krimmel, Sabrina Spianu, and Danielle Hale, also shows us something else crucial. While inventory soared, the corresponding drop in median sale prices wasn't nearly as dramatic as you might expect. In fact, Cotality's chief economist, Selma Hepp, noted in March 2025, referencing January data, that U.S. home prices were largely flat. Flat prices, surging inventory, and still sticky inflation elsewhere? That's not a market cooling gracefully. It's a coiled spring. And this isn't some abstract economic theory. This is about why your weekly grocery bill still feels like a luxury purchase and why that dream of a lower mortgage rate might be harder to grasp than you think. What we're looking at today isn't just about inflation. It's about the invisible hand of regulatory shifts and insurance premiums quietly picking your pocket. It's about why the mechanics of the housing market are fundamentally different than what we saw in 2008, despite some very real echoes. We're going to break down exactly what's happening in places like Phoenix and Tampa and why you need to understand these underlying currents now, not 6 months from now. Let's dive into the numbers and see what they really reveal about the inflation time bomb that's ticking right under our feet. For instance, by early 2025, overall U.S. inflation largely eased towards the Federal Reserve's 2% target, a point Robert McAllister, chief economist at Sterling Financial, highlighted in his comprehensive analysis updated on June 2, 2026. This seemed like a significant win, prompting celebratory headlines. Yet, beneath that aggregated headline, the U.S. had just experienced the fastest food price increases since the tumultuous 1970s following the initial shockwaves of COVID-19. What does that specifically mean for your household budget, for the average family, like the Millers in Ohio? It means grocery prices remained stubbornly elevated, a relentless anchor on weekly spending, even as overall inflation cooled throughout 2024 and into 2025. You might be thinking, but didn't food inflation come down? Yes, it did, marginally. According to the U.S. Bureau of Labor Statistics Consumer Price Index report, U.S. food inflation eased to 3.1% in May 2026, down from 3.2% in April. On the surface, that looks like incremental progress. However, compare that to the long-term historical average, which typically hovered around 2.5% for the 2 decades preceding 2020, a significant difference from the 3.46% figure many remember from earlier in the century. This persistent disconnect between official inflation rates and the everyday cost of living is precisely what economists Ashley Ji-Yoon Kim and Sung-Hoon Yoon detailed in their influential Q1 2025 article for the Economic Policy Institute. Grocery inflation is low, but why do consumers feel it is high? They captured that exact sentiment. The macroeconomic numbers might be improving, but the palpable strain at the checkout counter, seeing the price of a gallon of milk or a dozen eggs hasn't changed. It's this persistent, higher baseline for food prices that creates a different kind of financial pressure. This isn't just about percentage points. It's about a fundamental, lasting shift in your disposable income, affecting everything from your monthly savings rate to your ability to qualify for a mortgage or fund higher education. This grocery price surge goes beyond simple numbers, and here's why. But dig deeper, and you find that from February 2020 to June 2022, food at home prices surged an astonishing 22%. This wasn't just a blip. It was a fundamental repricing, a great grocery reset, driven by a perfect storm of robust consumer demand and profoundly fractured global and domestic supply chains, as meticulously detailed in the New York Fed's Liberty Street Economics piece. What was up with grocery prices? Published in November 2022. The most telling data point from their analysis, based on Nielsen IQ scanner data, during that period, American households actually bought 11% less in volume, but spent 9% more on groceries, a stark reflection of unit price inflation. Think about that. You're literally getting less physical product, yet paying substantially more per unit for staples like ground beef, which saw a 27% price jump, or eggs, which skyrocketed over 60% at their peak. Part of this was a significant behavioral shift. During prolonged lockdowns and restaurant restrictions, families like the Smiths in suburban Atlanta weren't dining out. They were cooking more at home, often opting for more premium products or buying in larger quantities to minimize trips, which naturally bumped up those total grocery bills. Even as headline food inflation has reportedly cooled to 3.1% year-over-year as of May 2026, the cumulative effect of those initial, rapid surges means your grocery basket is still significantly more expensive than it was pre-pandemic. It's why you might hear economists like Lawrence Yun at the National Association of Realtors say inflation is easing, but you still feel that sharp sting at the checkout when your bill for a week's groceries hits $180 instead of the pre-pandemic $120. That feeling isn't wrong. The baseline has simply shifted dramatically. This persistent pressure on everyday necessities is actually shaping consumer behavior in unexpected ways, even impacting how people think about bigger purchases like housing and discretionary spending. But it's not just your grocery bill taking a hit. The housing market is undergoing its own profound reset, presenting a dramatically different landscape for prospective buyers than just a few years ago. We're essentially in a period of what some economic analysts, like those at Moody's Analytics, are calling wartime economics for housing, characterized by tight credit and elevated costs. Consider the inventory. As of early Q1 2026, we're seeing 806,198 active units on the market, an increase of 10,277 homes from the previous month. More significantly, the Realtor.com May 2025 Monthly Housing Market Trends Report, authored by lead economist Jay Krimmel, Sabrina Spianu, and chief economist Danielle Hale, showed a massive 31.5% year-over-year increase in homes for sale. That's a dramatic alteration of market dynamics. Think about it. Just 18 months prior, buyers in hyper-competitive markets like Boise, Idaho, or Austin, Texas, were facing aggressive bidding wars and waiving appraisal contingencies on homes listed for mere hours. Now, that kind of frantic frenzy is largely gone. U.S. home prices were largely flat by January 2025, according to CoreLogic's chief economist Selma Hepp, suggesting a definite plateau after years of rapid appreciation. Dave Gallagher, in his May 7, 2026 report for Bloomberg, noted good news for the lagging housing market, quoting Zillow's chief economist Skylar Olson, who stated, "The math has shifted in favor of buyers." And they're not wrong. However, this newfound buyer leverage is significantly tempered by one critical factor: the 30-year fixed mortgage rate. It's currently hovering around 6.79%, a slight increase from last quarter, and a persistent impact on overall affordability. So, while you might have more choices, the cost of borrowing remains stubbornly high. Let's unpack that further, because understanding housing affordability and those persistent rates is absolutely key to what comes next. The underlying mechanic here is a complex interplay between quantitative easing and the cost of capital. Aaron Klein and Alan Shui, in their October 8, 2025 Brookings article, rigorously examined the strong link between quantitative easing post-COVID and housing inflation, fundamentally influencing current price levels. They argue that the Fed's aggressive bond buying created an artificial demand floor. Now, while we've seen overall home prices largely stabilize, remaining relatively flat by January 2025 according to Cotality's chief economist Selma Hepp, the cost of borrowing has gone through the roof. We're looking at average mortgage rates around 6.79% right now, a stark contrast to the sub-3% lows we saw during the pandemic. This means that even if a home in, say, suburban Phoenix is selling for roughly the same price it did a year ago, your monthly payment is significantly higher. The good news for buyers, at least in terms of choice, is that inventory is up. Realtor.com's May 2025 monthly housing market trends report by Jake Krimmel, Sabrina Spianu, and Danielle Hale showed a 31.5% year-over-year increase in homes for sale. That's more options on the table, and homes are generally staying on the market longer. New listings are finally appearing, suggesting a less frenzied environment than we've endured for years. Dave Gallagher, a prominent real estate market commentator, noted on May 7, 2026, that increased pending sales and a surge in homes for sale, online searches indicate renewed buyer interest, albeit cautiously navigating these higher rates and more robust inventory. But this isn't making homes affordable in the traditional sense, especially for first-time buyers. It simply means the market is recalibrating. The emotional aspect for consumers, that feeling of everything costing more, it's not just a gut feeling. It's rooted in these persistent, elevated costs that aren't fully reflected in the headline inflation numbers. And this gap between consumer perception and the official inflation data, that's where things get really interesting. And this brings us to a crucial disconnect: consumer perception versus statistical reality. While the overall inflation rate might be crawling back towards the Fed's 2% target by early 2025, a trajectory confirmed by Robert McAllister's April 2025 analysis of Bureau of Labor Statistics data, which projected a 2.1% annual rate by March 2025, the actual feeling at the checkout counter hasn't fundamentally shifted. Ashley Jiun Kim and Sung-Eun Yoon directly tackled this in their Q1 2025 Choices magazine online article. Grocery inflation is low, but why do consumers feel it is high? Their core argument isn't about the current rate of inflation, which has indeed decelerated. It's about the significantly elevated absolute level of prices, especially for non-discretionary essentials. Consider the stark reality. The 22% surge in food-at-home prices from February 2020 to June 2022, according to USDA ERS data, isn't being undone. That monumental increase is now built into the baseline. Consumers aren't comparing today's $4.50 gallon of whole milk to last month's $4.40. They're remembering the pre-pandemic $3.29 price for that same gallon, or the $1.99 loaf of Wonder Bread that now costs $3.50. As Professor Ravi Dhar, director of the Yale Center for Customer Insights, articulated on August 22, 2022, people's beliefs are not logical, they're psychological. He notes perceptions are often driven by attention-grabbing changes, like a 30% jump in the price of a specific staple like eggs, rather than the smooth aggregate data. So, while the rate of increase has slowed, the sustained high plateau for your daily necessities feels like an ongoing inflation time bomb, disproportionately hitting household budgets. This isn't just an academic distinction or a nuance for economists. It's the tangible financial friction most families feel every single week when scanning their groceries at their local Kroger or Walmart. So what does all of this tell us? It's not just about headline CPI numbers ticking down. For the average American household, the inflation time bomb isn't about new price surges in 2025. It's about the entrenched, elevated cost of everything that feels like a persistent weight, even as official figures hint at cooling. You're seeing this in your grocery cart every week, and you're feeling it in the housing market. where despite a 31.5% year-over-year inventory increase in May 2025, as reported by Realtor.com, affordability remains stretched due to high rates, even as home prices largely flattened by January 2025, according to Cotality's Selma Hep. It's the cumulative effect of a reset, where back to normal feels nothing like what we remember. Have you noticed your grocery bill staying stubbornly high, even as news channels proclaim inflation is down? Or perhaps you've been watching the Phoenix metro or Austin market, seeing more homes, but still feeling locked out by rates? Share your specific experiences in the comments below. How is this economic reality playing out for you? And if you want to understand the mechanics behind these shifts, hit that subscribe button. Next, you'll want to watch my deep dive into the 2026 mortgage rate outlook and how potential Fed actions could either alleviate or intensify this affordability crisis.